Today is the 18th of July 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500. I also have data from SPX and from ES Futures, so the data is a little bit of a mixed bag, but they are of course all based upon the S&P 500 cash index, and so that is the focus of today's market update. Before we take a look at the markets, I would like to invite you all to join us on our new Discord server. We started the server last week for users of Sentient Trader software, the MT4 Hurst Cycles indicators and Hurst Signals subscribers, and the server has already grown and become a very valuable resource if you are interested in Hurst cycles and how those cycles influence financial markets. I would encourage you to join us on the Discord server and get involved in the discussion. I have often said that the most valuable part of everything that we do, I believe, is the community. And I have learned more from other members of this community than I have learned from Hurst's original cycles course or from developing Sentient Trader software. So come along and get involved. There are some very experienced Hurst cycles analysts and Hurst cycles traders in the community, I can tell you. So please come and get involved and learn from them. So let's take a look at the S&P 500. This is SPX data, as you can see. This is the analysis we've been looking at for many months, with a very important cycle trough, of course, in March of 2020. The 18-month cycle trough, in my opinion, formed at the beginning of October of last year, and what we've been discussing for several weeks is the formation of a 40-week cycle trough. This is one of the analyses that we looked at in the previous market update about the S&P 500, and as you can see, I have pinned, in other words, influenced this analysis to position that 40-week cycle trough over there in the middle of June. This is, as I mentioned, one of the analyses that we were looking at. The other analysis that I discussed in the previous market update video was this one over here, which hasn't pinned the 40-week cycle trough to the low point in June, and so therefore the 40-week cycle trough is potentially still being formed. So the first thing that we need to discuss is the formation of this 40-week cycle trough. Has it formed or hasn't it? Let's take a look at some more detail. Let's start with this analysis that doesn't assume that the trough has formed. As I mentioned in previous update videos, we have the circle for the 40-week cycle just below that trough that formed in the middle of June, which is often an indication that we should pay attention to the fact that that trough might have formed there. You will sometimes see this happening in your Hurst cycles analysis, where you have a stack of diamonds, in this case up to the 40-day cycle trough, and then above it you have a floating circle and whiskers. The circle is, of course, the exact date at which the next trough of that cycle is expected. The whiskers, or the lines to each side of that circle, indicate the range of time in which that trough could reasonably form. And these circles and whiskers tend to form nests of lows at the foot of the chart, which are stacks of circles and whiskers, which provide us with some idea of when a trough is likely to form. This particular formation, where you get a stack of diamonds and then a floating circle and whiskers, is something that you will often see. I often speak about it, and it always raises the question of whether that trough has indeed formed over there. In the previous two market update videos, I believe, when I was speaking about the S&P 500, I have suggested that the 40-week cycle trough did indeed form there. If it didn't form there, then what would we have expected? Well, as mentioned, we have a 40-day cycle trough over there in the middle of June, and so of course we would be looking at the final 40-day cycle, bringing us into the 40-week cycle trough. I would like to point out here what might be a little bit of a misunderstanding in terms of these market update videos. I spend quite a lot of time discussing whether a trough has formed or whether it is still lying ahead of us, and some people interpret that as being a lack of certainty or a lack of being able to work out what's happening in the markets. That's not really the case, because if this is a 40-day cycle trough that formed in June, we would expect an M shape to elapse into this 40-week cycle trough. If, however, that was a 40-week cycle trough that formed in June, we would expect the same M shape, but it would be a more bullish M shape, of course, as the market rises out of the 40-week cycle trough. My point is that Hurst cycles give us insight into what the market is likely to do in terms of the structure of the move, when it is likely to be moving up and when it is likely to be moving down. This discussion about the magnitude of the cycle troughs is something that I find fascinating, and of course we need to structure our longer term trading decisions on the basis of where those troughs have formed. But being able to anticipate a trough and being able to anticipate the shape of the move as price comes out of that trough is really what this is all about. My point is that whether the 40-week cycle trough did form in June, as I continue to believe that it did, or whether that was a 40-day cycle trough, we could nevertheless have benefited from the price moves that have followed. I hope that that makes some sense. So let's consider the price moves that have elapsed since this trough in June and ask ourselves whether they provide us with any further information. Let's display the 20-day FLD, because this is, as you know, my favorite FLD when looking at this kind of time frame. And let's consider what we would have expected if the 40-week cycle trough was still lying ahead of us. I went through this sequence of interactions, I believe, in the previous market update video, but in any case, here they are. If this is the correct analysis, then the 80-day cycle trough formed over here in May, and this was our A category interaction. At about the time that the 20-day cycle trough formed, we would have expected the market to find support at the level of the 20-day FLD. It found support much higher than the level of the 20-day FLD, as you can see, but that would have been our B and then C category interaction. The D category interaction was when price crossed down below the FLD on its way down to the 40-day cycle trough, which we see in this analysis over here. At this point, we are beginning to question the shape of this cycle, because that is a very strong move for a D category interaction. That looks much more like an F category interaction, but I'm going to come back to that in a moment. The next interaction, if this is the correct analysis, would have been the E category interaction, where price is expected to come up and achieve its target, which it pretty much did. But this is where the sequence of interactions, according to this analysis, begins to fall apart, because the next interaction is where price is expected to cross down below the level of the FLD in an F category interaction on its way down to the 40-week cycle trough. Over the past 2 weeks, price has failed to do that. It has come down to the FLD, found approximate support, struggled back up again, come back down to the level of the FLD, found approximate support again, and struggled back up again on Friday and in early trading on Sunday night. So that does not look like an F category interaction, which means that although it is possible that price is now going to move down and form a lower 40-week cycle trough, at this point, I think it is much more likely that the preferred analysis that we've discussed in the last few market updates is in fact the correct one, that the 40-week cycle trough did form in the middle of June. So let's take a look at that analysis in more detail. Here is that analysis with the pinned trough for the 40-week cycle in the middle of June. And as you can see, there have been 31 days as of today. I'm recording this video early on Monday morning. In fact, it isn't really even Monday morning in the US yet. It is morning in Europe. And so what are we looking at here? Well, we have an M shape that has clearly formed. There is that M shape. And now the market is already bouncing back up again. Here is the nest of lows for the 40-day cycle trough. You will notice immediately, I'm sure, that the whisker for the 40-day cycle is extending over to the left-hand side over here, and this is a potential position for that 40-day cycle trough. What is the average length of a 40-day cycle? It is, of course, 34 days. And so according to the average length of the cycle discovered 50 years ago by Hurst, we would expect another few days to elapse before the 40-day cycle forms. That is why we have this nest of lows over here. However, we have to ask ourselves, is it possible that this is the 40-day cycle that has formed? What I like to do in this kind of situation is I measure the number of bars that have elapsed, and I ask myself, first of all, is it possible that the 40-day cycle has come in at 27 days? It is certainly possible. That would represent a cycle that is about 20% short of the average length discovered, as I mentioned, 50 years ago. But the next thing that I like to do when considering the possibility that this trough has formed is I look at the structure of the market and I ask myself whether I can find a suitable trough for the 20-day cycle at about the halfway mark. So the halfway mark for 27 days is 13 and a half days. Here is that halfway mark. And indeed, there is a bit of a trough in the market at that time. Let's display our 20-day FLD. And this is where the pieces of the puzzle begin to fall into place, in my opinion. I have mentioned, of course, that we have a sequence of interactions. There is our A category interaction as price crossed up above the FLD, and it looks as if though it pretty much achieved its target. Price is then expected to find support at the level of the 20-day FLD at about the time that the 20-day cycle trough forms, and we have just counted that there were 13 or 14 days to this low point, at the point at which price found support at the level of the FLD, and so in my opinion it's very likely that the 20-day cycle trough did form over here. Sentient Trader has positioned the 20-day cycle trough at this low point over here. It was a slightly lower price point, I believe, and of course that brings the cycle a little closer to the normal average length of the 20-day cycle, which is 17 days. Nevertheless, I think it is very likely that the 20-day cycle trough in fact formed below this price low over here at the end of June or the beginning of July. That would mean that this is a 40-day cycle trough that formed last week. Now, this is where things get interesting in terms of the discussion I had a little earlier with regard to the possibility that this is only a 40-day cycle trough that formed over here. If a 40-day cycle has elapsed since that point, and there is our M shape, that would mean that it is possible that the 40-week cycle trough actually formed over here last week. Now, usually we would expect the 40-week cycle trough to occur at a lower price level, but in fact Hurst spent some time in his cycles course discussing this apparently displaced trough situation, where in fact the trough should be correctly positioned not at the price low but at the slightly displaced position. I'm not suggesting that that is what has happened here, but it is certainly a possibility. And so let's discuss what we are expecting next. And let's get on to one of my favorite subjects, the idea of cycle shapes, or the shapes that cycles form in markets. Here is the important point about the formation of this 40-week cycle trough. We have the beginnings of a cycle shape. I've mentioned, of course, that cycles create M shapes in markets, and if this was an 18-month cycle trough here at the beginning of October, which is something that I've assumed for several months now, then we have experienced the first half of an M shape. The next half is going to give us a move up. We're going to form a peak at some point, and then we're going to get a move down into the 18-month cycle trough expected, according to this analysis, early next year. And so this is our focus at the moment, the second half of this M shape. You will notice that I have drawn it with price not achieving a new high and price moving down to a lower low. The reason for that is because this 40-week cycle that should elapse over here is of course expected to be less bullish than the previous one. Let me explain that just quickly. Let's zoom in here and consider just the 18-month cycle. We expect price to move up from an 18-month cycle trough and then form a peak and then move down into the next 18-month cycle trough. Of course, at about the time that the 18-month cycle is forming a peak in the markets, the 40-week cycle is forming a trough. The result of this, when we combine the cycles, is that we get a move up, and then we get a move down into the 40-week cycle trough, and then we get another move up, and then we get another move down. What I've drawn there is a fairly balanced M shape. But at this point, we need to ask ourselves, is this going to be a balanced M shape? It is certainly not a balanced M shape so far, because price has moved down fairly strongly into this 40-week cycle trough. The result, of course, is that we are expecting the entire M shape to be distorted to the downside, meaning that we are going to experience a smaller move up, or at least not a move up that is going to achieve a new all-time high, and then we are going to experience an early peak and then a move down into a lower trough for the 18-month cycle, trough expected early next year. If we zoom in, we can use the composite model line tool to understand the implications of this analysis. The composite model line tool takes the information from the cycle analysis on the chart. It combines that information to show us what is expected to happen, assuming that these cycles continue to beat with the same wavelength and amplitude. The bottom line that this composite model line is showing us is, of course, several M shapes. We are first of all going to get this M shape into the 20-week cycle trough expected over here in October, and then we will get another M shape into the 18-month cycle trough expected early next year. The important information contained in this composite model line is the fact that we are going to experience an early peak, followed by a fairly prolonged move down into the 18-month cycle trough. Now, I would like to show you something interesting about this composite model line. It is based only on the trough analysis, which is, of course, the analysis that we mostly speak about when it comes to stock markets, because of the principle of synchronicity that Hurst announced 50 years ago, which declares that cycles that influence stock markets are synchronized at their troughs. I discussed this at some length in last week's video when we were looking at the price of gold. So I won't say very much about it now, but I should point out that of course we can perform an analysis assuming that the peaks of the stock market are synchronized. While not likely to be a very accurate analysis, it can provide us with some useful information. And what I would like to do now is display the composite model line that combines a trough analysis and a peak analysis, and then discuss what that tells us. There is that composite model line. What is particularly interesting is you can see it suppresses the composite model line in a downward fashion. It provides us with a much more closely matched price action recently. The important troughs, as you can see, have not in fact moved in this composite model line. They are still pretty much in the same places. However, the general cycle shapes have changed. We would still be expecting a fairly early peak over here, early August according to this composite model line, but we might experience a higher peak over here in about November of this year before the markets turn down into this 18-month cycle trough. If I zoom back out again, you can see the reason why that peak analysis influences the composite model line in that way. It is because the peak analysis has found a very important peak of 54-month magnitude at the beginning of this year. If indeed that peak was of 54-month magnitude, that would certainly explain why we are experiencing bearishness in this market, and it would imply that we should continue to expect bearishness. Therefore, rather than expecting price to break out to new all-time highs following this 40-week cycle trough, we would expect an early peak to form, and our focus would be on the fact that the markets are going to continue lower. Is there a bullish possibility? Is there any hope for the bulls out there? Well, many weeks ago I presented an alternate analysis of the S&P 500 using ES futures prices, and that involved the initial cyclic model. Let's take a look at that. Here is the analysis based on what Hurst called an initial cyclic model. The way this analysis works is that it takes the information generated by the spectral analysis process that Sentient Trader performs at the beginning of the analysis process, and it places greater emphasis on the results of that spectral analysis in performing its standard pattern recognition analysis. The result is that you end up with a slightly different nominal model. And in fact, if you take a look at the wavelengths of the cycles that have been found in this analysis, you will see that they differ from the standard Hurst nominal model. We can find the information about the nominal model that Sentient Trader is now using as a result of the initial cyclic model, and it is presented here. You can see the numbers in brackets that have been presented for each cycle. So the 54-month cycle, which is of course normally of an average length of 54 months, has been found to be of only 42-month wavelength. according to the initial cyclic model. The 9-year cycle is only 7.2 years, and the 18-year cycle has been found to be only 10.8 years, although that's probably a fairly unrealistic wavelength. But you can take a look at the wavelengths that have been found in this initial cyclic model to understand the nominal model that CentianTrader is working with here. The interesting thing about this analysis is that, of course, it also has a very prominent trough in March of 2020, but the position of the 18-month cycle is very different. It is positioned here in May of last year. If you go back and take a look at market update videos that I was recording at about that time last year, you will know that I discussed the possibility that an 18-month cycle trough was forming in May and June and July. And there are some Hurst cycles analysts that continue to believe that the 18-month cycle trough should be correctly positioned at one of those trough positions. The initial cyclic model analysis is therefore quite interesting because it presents this possibility. The important thing to note about this analysis is this nest of lows for the next 18-month cycle trough, which is of course below this trough that has just formed. And if we zoom in and take a closer look at that, you can see that we have a very interesting situation here. We have the 18-month cycle nest of lows in the position where the 40-week cycle nest of lows was in the other analysis. And here we have the final 40-day cycle that was expected to play out to bring us down into this 18-month cycle trough. Everything that I said about the other analysis in terms of the 40-week cycle trough applies here. It is therefore very possible that the 18-month cycle trough formed according to this analysis in the middle of June, or possibly it was a displaced trough over here last week. I don't present this analysis to confuse you. I hope it isn't too confusing. It simply suggests that the magnitude of the trough that we have recently experienced is possibly of a slightly greater magnitude, being 18 months instead of 40 weeks. I'm presenting this because it presents a slightly more bullish possibility. Let's take a look at that in a little more detail. First of all, I have also performed a dual analysis on this chart, and so if we display the analysis of the peaks in this chart, you can see it is presenting exactly the same possibility, that a very important 54-month cycle peak formed at the beginning of this year. I think that was in the first few days of January of this year. And so in fact the differences between these analyses are not very great. Let's display the composite model line to understand the implications of this analysis. Here you can see the composite model line is telling us to expect price to bounce out of the trough that has formed recently of 18-month magnitude. There it is over there. And of course this composite model line presents a more bullish picture, rising up into a slightly later peak towards the end of this year, followed by the move down into the next 18-month cycle trough. And so, although this is a slightly more bullish possibility, it is not really that much more bullish, as I think you can see. The bottom line is that we are looking at price bouncing out of the trough that formed in the middle of June. It is probably going to form a fairly early peak and then continue to move down into the next 18-month cycle trough expected early next year. Let's display one more tool that we have here, the Zig-Zag tool in CentianTrader. This presents the expected price move for each one of the cycles. And here is the 18-month cycle Zig-Zag tool. You can see we are expecting a price move up into a fairly early peak, which according to this analysis and this tool is expected in about October, followed by a move down into the 18-month cycle trough, which is expected early next year. I do hope that you found this market update useful and interesting. Please come and join us on our Discord server. If you have any questions, you're very welcome to ask them on the Discord server or ask them in the comments below this video. I look forward to hearing from you.